Good morning, everybody. Happy Wednesday to all you magnificent melon heads out there. Today is July 19th, 2023. Stocks are up today. Why? Because companies are making more money? Because the economy is doing better? No, silly rabbit. That's just what stocks do. They go up. Why are they going up this morning? I don't know. Maybe it's because Goldman Sachs, the largest investment bank in the world, I'm pretty sure they're the largest investment bank in the world, certainly the largest investment bank in the U.S., their earnings, their profits were down by 58% year over year. More than half. Now, Goldman Sachs, congratulations. You have done the unthinkable. You have missed expectations in 2023, a year that has been known for ridiculously low expectations. Case in point, we had Samsung beat expectations with a 93% decline in earnings a few weeks ago. Well, Goldman has been warning for weeks. There have been red flags. There have been notes issued by the company trying to prepare investors for just how lousy this quarter was going to be. And even still, Goldman Sachs managed to miss expectations. So congratulations to Goldman Sachs for doing the unthinkable. Also in Goldman Sachs earnings, the first mention in bank earnings of commercial real estate. The company took almost a $1 billion impairment charge, not quite $1 billion, half of which came from losses for commercial real estate. That's the first big bank to mention commercial real estate losses. And I would add, Goldman Sachs doesn't really have that much exposure to commercial real estate. It's mostly the little banks that have commercial real estate exposure. So that's not a good omen for the regional banks. Now, all that being said, bank earnings so far have been okay. Now, the market is priced for perfection, but if you were expecting the banking crisis to be reignited by the big banks, we have not got that. So far, bank earnings, though they've been meh, they haven't been good, but they haven't been terrible. I guess they've been good enough because, well, number go up. Also going on overnight, we had a second consecutive night of Russian missile attacks on the Ukrainian port of Odessa. That's after Russia pulled out of the Black Sea grain deal. It was yesterday or 2 days ago they pulled out of the deal. That deal had been previously cut last year that allowed vital shipments of grains, namely corn and wheat, to be exported out of Ukrainian ports safely. Turkey had brokered the deal. Why? Because that's vital food supplies for mainly the global south, especially developing economies. And, well, Russia withdrew from that deal 2 days ago. And for 2 consecutive nights, they've launched missiles at that important port of Odessa. And this morning, we've got corn and wheat prices are surging as a result of that. So keep an eye on what is going on over there. Also, Carvana, I don't know, what would you call it? The used car zombie? Carvana, one of the worst performing stocks of the year. Their stock is absolutely surging this morning because they restructured their debt. $1.2 billion worth of debt was just penciled away overnight. It's a selective default. They're saying it's a restructuring or that they've eliminated debt. They're not paying people back, and the stock is rallying because of it. The company's also issuing $1 billion worth of stock. But case in point, the company just doesn't make money. So while they have eliminated a vast majority of their interest expense and they've cleaned up their balance sheet a little bit, you're still left with a company that does not make money, although nobody cares. The stock is just surging. And Bloomberg is warning of a $500 billion corporate debt storm. We'll get into that one in a little bit. But first, we have got to shrink my big melon of a head, and let's see what's going on in these markets. And CNN Fear Greed Index is now sitting at 84. This is fine. What's the worst thing that can, you know what? Stocks only ever go up, right? They never go down. Just YOLO into calls, way outside the money calls that expire tomorrow. I'm sure everything will be fine. Please note my sarcasm here, folks. Good God, 84 on the Fear Greed Index. This thing has now been over 70. I believe this is 49 consecutive days that the Fear Greed Index has been over 70. Since June 5th, we have been in extreme greed territory. I'm sure this is going to end very well for everybody involved. The S&P is up 13 points today, or 0.29% at 4,568. We've got the Dow is up another 167 points at the open. That's another 0.5% for the Dow, 35,119. And the NASDAQ is up not quite as much as the other indexes, 0.25% for the NASDAQ, up 35 points, 14,388. We have got the DXY is taking a break from its decline this morning, back over 100, up 25 basis points at 100.19. I don't know if this is a dead cat or what, but the Dixie was due for a little bit of a bounce here. I wouldn't look too much into this right now. Still below its support level that it had recently broken through. In the bond market, we've got yields are largely lower across the board. The 30-year Treasury yielding 3.89. That's down 1 basis point. The 10-year at 3.77, down almost 2 basis points. 2 years down 2 basis points at 4.73, and the 1 month yielding 5.28, essentially unchanged for the day. Yields continue to move lower. In the commodity space, we got a lot of movement in commodities this morning. Gold is up about 35 cents, 1,981 for gold. Silver's up 7 cents, 25.33 for my favorite of the shinies. We've got platinum and palladium are both down this morning. Platinum down $1.60 at $992. Palladium at $13.07, down about $9. WTI crude at 76.47. That's up 81 cents. WTI is going to make a run at that 200-day moving average again. We'll see if it can break through there today. And I just also want to mention grain prices. Take a look here. U.S. wheat up 5.28% this morning at $705. And U.S. corn futures up 4.28% this morning at $5.56. That is on the back of those Russian attacks on the port of Odessa. Here you go. Kyiv says Russia targets grain infrastructure with strikes on Ukraine's Odessa port. This is dated just this morning. Russian missiles strike Odessa for the second night in a row. The attack follows a blast on the Crimean Bridge, which has been blamed on Kyiv. Ukrainian official says Moscow seeks to prevent grain exports, and Moscow had left the grain deal, but Kyiv is considering exports anyway. The Russian Navy may have something to say about that. Ukraine accused Russia on Wednesday of damaging grain port infrastructure in hellish overnight strikes focused on 2 of its Black Sea ports, vowing not to be intimidated from working to keep grain exports moving out of them. Russia attacked the Odessa region for the second consecutive night after quitting a deal on Monday that allowed the safe passage of Ukrainian grain through the Black Sea. So most of the people paying the price for this, folks, are not going to be in Ukraine or in Russia. It's going to be in Africa, the Middle East. It's going to be in the global south. Now, I expect most of this Ukrainian grain will still manage to reach the end market. It's just going to take longer, and it's going to be more expensive. It's going to have to move west by rail first, basically circumnavigating over land to get around the Black Sea, and then load it on the ships where it can get to its final destination. It's just going to drive up food prices for everybody. Looking over at the oil markets right now, it looks like oil's going to make its second run today at the 200-day moving average. Here we go. It rejected the first time. We'll see if it can break through this time. RSI down around 63. So it looks like oil may have a little bit of momentum left to spare here. We'll see if it breaks through that line. And something I want to mention here, take a look at platinum futures. This is the chart going back to about the beginning of the year. And we've got yesterday, platinum failed to retake both its 50 and 200-day moving averages. It's trading below that level right now. And we have got a death cross in progress, folks. The 50-day moving average has crossed below the 200-day moving average. That is a major bearish technical indicator. And this is not good things for the auto market. Remember, Carvana just restructured $1 billion of their debt. We've got notes out recently about auto loans are getting rejected at the highest rate ever. We've got student loan payments are coming back. Why am I mentioning that? Because that is all very bad for the car market, and 40% of platinum goes into catalytic converters for the automotive market. So we could see a sudden drop in demand for platinum if we get any kind of turmoil in the auto market, which I expect is coming. And that could be why platinum futures are making this technical move at the moment. Keep an eye on this one right around resistance, and that death cross, not a good sign. But here is the big story today. Goldman Sachs misses on profit after hits from Green Sky and real estate. Revenue of $10.9 billion versus $10.84 billion estimated. Goldman Sachs on Wednesday posted profit below analysts' expectations amid write-downs tied to commercial, real estate, and the sale of its Green Sky lending unit. Second quarter profit fell 58% to $1.22 billion or $3.08 a share on steep declines in trading and investment banking and losses related to Green Sky and real estate, which sapped about $3.95 from the per share earnings. Company-wide revenue fell 8% to $10.9 billion. Now, Green Sky was Goldman Sachs' ill-fated venture into retail banking, if you will, savings and loan. Goldman Sachs is predominantly an investment bank, So they tried to get into savings and loan banking. It did not go well. That's what this $504 million impairment charge they're taking for Green Sky. But what I'm more worried about is that equally impressive $458 million real estate write-downs. That is commercial real estate. That's the first sign of commercial real estate turmoil in bank earnings this quarter. So it's been largely absent because mainly the commercial real estate exposure is in the small banks, not in the big banks. Well, Goldman Sachs is definitely one of the big banks, and they're taking a $500 million hit from commercial real estate. Keep an eye on that one. That is one of the biggest threats to the economy right now, and it's showing up with almost a $500 million loss for Goldman. And Goldman Sachs stock, well, they're down 1% today. And this is just another wonderful metaphor for this economy, guys. Goldman Sachs profit falls 58% year over year, and the stock is down not even 1% on that news. Okay, if you say so, good luck, Goldman shareholders. Moving on, we got Western Alliance Bank. That's one of the regional banks that was mixed up in the banking crisis from March through May. They reported yesterday after the close, and it was bad, but it wasn't awful. And so that is enough. Western Alliance is out with its second quarter earnings after investors are sifting through the results for signs of whether the turmoil that hit regional banks earlier this year is still a danger. Now, deposits were down 5% from a year ago. That's bad, but they're up 7% from the previous quarter. That's really good. That means the run on Western Alliance Bank has stopped. Deposits are up 7% from last quarter. So that is very good news. But in the next line, you see what it's going to cost them, and it is expensive. Net income dropped 17% from the same quarter a year ago. That had amounted to earnings of $1.96 per share. The bank paid higher fees for deposits and other funding weighing on its margins. And that's the rub there, higher fees for deposits. Western Alliance had to raise the interest rates that they're paying on their deposits in order to keep that money from fleeing. So that's hurting their profit margins. But they also had to borrow expensive money from the Bank Term Funding Program and from Federal Home Loan Banks. That's very expensive debt that they had to borrow in order to give people their money back as they were running on their deposits. So that is squeezing the margins at this bank, making it less profitable. So they have traded a short-term solvency crisis for a long-term problem in their business model. Long-term cash flow is going to be non-existent for this bank. So that's going to make them vulnerable to a takeover. Western Alliance right now down 1.45%, trading at 42.44. Another big story this morning, Carvana soars after reaching a debt restructuring deal. In other words, they're defaulting on $1 billion worth of debt. Bondholder deal extends maturities and cuts debt by $1.2 billion. The auto retailer also files to sell up to $1 billion of shares, so they're diluting their shareholders also. Carvana reached a deal to restructure debt and filed to sell as much as $1 billion a share as the used car retailer tries to regain its footing following a pandemic boom and bust. The agreement with bondholders announced Wednesday will eliminate 83% of Carvana's 2025 and 2027 unsecured note maturities and lower required cash interest expense by $430 million a year for the next 2 years. The used car retailer expects that it will reduce total debt outstanding by $1.2 billion. So the stock is absolutely running like the blazes on this news. What it amounts to, guys, that's $1 billion, $1.2 billion is going up in smoke. The bondholders realized they were never going to get paid back by Carvana because Carvana does not make money. This debt was as good as gone. And so, of course, they accepted a massive haircut on their investment in Carvana. The deal, supported by key creditors, including Apollo Global Management, sent Carvana shares soaring as much as 48% in pre-market trading, though they paired gains after the company filed for the stock offering. One more thing I want to mention here. Interest expense of $155 million, that was for the quarter they just reported, amounted to more than $2,000 per car in the period. Understand how big of a problem debt was for Carvana. They had so much debt, adjustable rate, that they took out at lower rates, thinking interest rates would never go up. And then, of course, interest rates did go up. You can see in this chart, this is their interest expense going all the way back to 2019. And whoops, there's the Fed rate hikes. Look what happens to their interest expense. It goes up to almost $160 billion. I'm sorry, $160 million. So based on the number of cars Carvana was selling, interest alone on their debt was costing them $2,000 per used car that they sell. That's more than the profit margin on those cars. Used cars is a very thin margin business. They only make about $2,000 per car when they sell a used car, which means everything that they had coming in was just barely enough to pay for their interest, let alone the expenses of running these giant vending machine car towers that Carvana runs. This business model is garbage in this interest rate environment. And so the bondholders realize we're never going to get our money back. We might as well accept a write-down and take what we can get. Well, Carvana stock, guys, is surging this morning. Now, it's currently up 24%, which is still a huge move. Pre-market, it was up 48% at one point. I'm going to leave this one alone. Something tells me this business is still screwed in the long run. They're still not making money. They're still not profitable. This is a zombie company that will not be around several years from now. And speaking of zombie companies, last one I want to touch on today, a $500 billion corporate debt storm builds over the global economy. Fears of a credit crisis have receded, but a wave of corporate bankruptcies is building now that an era of easy money has come to an end. And this is what I have been warning about with these interest rate hikes for the better part of a year, that companies cannot afford the debt. And before we talk about this, I have to say, look at this chart. Oh my God, Bloomberg, what on earth are you guys doing? Personal foul, flag on the play. That's it. 15-yard penalty, loss of down. What on earth is Bloomberg doing with this chart? Who cuts a pizza like that? It's a freaking pie chart. It's supposed to be a visual representation that makes it easy for the eye to grasp the percentage of certain, in this case, distressed debts in the economy. Can you look at that gray one, which, by the way, that giant gray representing the largest slice of the pie? What category is that? Other. Other is the largest slice of the pie. Other is what you use to wrap up that miscellaneous 1% that's left over when the major categories that you're talking about go bad. Almost half of the freaking chart that, again, if you order a pizza and it shows up like this, I'm going to file a complaint. Who's going to eat this little slice here in the corner right next to other? Who gets to eat that little 35 software and services slice? Who makes a chart like this? Give me a break, Bloomberg. All right. I think I've ranted enough about the the pie chart here. Let me get to the meat and potatoes of this article. Oh, where did it go? Oh, I lost my place. Here we go. With growth cooling in China and Europe and the Fed expected to continue raising rates, payments may be too much for some businesses to bear. In the Americas alone, the pile of troubled bonds and loans has already surged over 360% since 2021. Remember that chart of the interest expense in the Carvana article? That's what this is talking about. Distressed bonds and loans at these higher rates, these companies just can't afford the servicing costs. If it continues to spread, that could lead to the first broad-based cycle of defaults since the great financial crisis. It's like an elastic band, said Carla Matthews, who heads contentious insolvency and asset recovery at consulting firm PwC in the UK. You can get away with a certain amount of tension, but there will be a point where it snaps. That's kind of a scary metaphor. What does it snapping look like? Well, that's already starting to happen. With more than 120 big bankruptcies in the U.S. alone this year, even so, less than 15% of the nearly $600 billion of debt is trading at distressed levels. Globally has already defaulted, the data showed. That means companies that owe more than $500 billion may be unable to repay it, or at least struggle to do so. This week, Moody's Investor Service said the default rate for speculative-grade companies worldwide is expected to hit 5.1% next year, up from 3.8% for the 12 months ended in June. And under the most pessimistic scenario, it could jump as high as 13.7%, exceeding even levels reached in the 2008-2009 credit crash. So this messy, disgusting pizza pie of a chart, which congratulations to Bloomberg's chart guy. I guess he's getting a little bit better with Microsoft Paint, and that's why he puts out a chart that looks like this. But what they're saying here, guys, is in these higher interest rate environment, after all of these companies took out these massive debts in 2021 and 2021, thinking interest rates would never go up again, now these companies are being driven insolvent by these higher interest payments. Case in point, Carvana and their $1.2 billion debt write-down. There is a wave of defaults and bankruptcies coming. So the clock is ticking on rate cuts. The only way this disgusting pizza does not become a problem is if interest rates are to lower sharply at some point in the next year or two. And that is why the market is saying the Fed is almost done with their rate hikes, because the market just cannot afford any more of this. All right, guys, I just want to say thank you so much to everybody for what happened here. There we go. I appreciate your time this morning. Thank you to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you guys on Patreon at lunchtime today. That is 12 noon Eastern time for our weekly Zoom call that we do every week. There's a link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.